Thank you, Jesse, and good morning, everyone. On the call with me today are Chris Bale, Inter Pipeline's President and Chief Executive Officer, Brent Hagee, Chief Financial Officer, Jeff Marchant, Senior Vice President, Transportation, Jim Madro, Senior Vice President, NGL Processing, and Corey Neufeld, Vice President, NGL Commercial. For today's call, Chris will provide a business and major projects update, and Brent will conclude with remarks on our financial performance. To start, I'd like to remind you that certain information on this conference call may contain forward-looking information that involves risks, uncertainties, and assumptions. Such information, although considered reasonable by Inter Pipeline at this time, may later prove incorrect, and actual results may differ materially from those stated or implied by our comments today. Undue reliance should not be placed on such information. A discussion of the related risk factors, uncertainties, and assumptions is available in our MD&A, which you can find on our website or at cedar.com. Please go ahead, Chris.
Thanks, Jeremy, and good morning, everybody. In 2019, it was a very capital-intensive year and an active construction year for Inter Pipeline, focused on the development and execution of the Heartland Petrochemical Complex, as well as the multi-phase build-out of our Central Alberta pipeline system. Combined, we invested $1.3 billion to advance these projects out of a total of $1.5 billion in growth capital expenditures during 2019. I'm pleased to report that work continues to progress well on phases 1 and 2 of our Central Alberta expansion. Batch operations and 10,000 barrels per day of additional truck offloading capacity at the Stettler Station have been completed, and the final component of phase 1 includes 2 new 130,000 barrel storage tanks that are expected to be completed mid-year. The Viking Connector, which includes 75 kilometers of pipeline bridging Inter Pipeline's Bow River and Central Alberta pipeline systems, is expected to be completed in April 2020 and at approximately 10,000 to 15,000 barrels per day of throughput volume once fully operational. During the first half of 2020, approximately $35 million will be invested to complete the first 2 phases of the Central Alberta expansion plan. Phases 3 and 4 represent over $400 million in future development potential, with commercial negotiations to underpin phase 3 ongoing. This phase, if sanctioned, would involve the construction of a pipeline lateral into the Three Hills region of Alberta's East Duvernay, where long-term producer production forecasts are up to 100,000 barrels per day. Moving to the Heartland Petrochemical Complex, I'm happy to report that the project is advancing as planned. During 2019, Inter Pipeline invested approximately $1.2 billion on the Heartland Complex, bringing the total project spend to $2.2 billion since inception. We are now more than halfway through the build and are making significant progress towards our scheduled late 2021 in-service date. 2019 was a very busy year in this regard, having successfully completed the majority of design work, procurement, and installation of major equipment. Most recently, maintenance and administration buildings were substantially completed, and work continues to progress on building our rail infrastructure. The propane dehydrogenation facility remains ahead of schedule and is expected to be mechanically complete in and around the end of 2020. The polypropylene facility is also within scheduled targets and is expected to be mechanically complete in the third quarter of 2021. Moving to Europe, we remain very active in a process to explore the sale of our bulk liquid storage our terminal business. There are no material updates at this time, but we expect to conclude the process within the first half of this year. A successful sale should enable Inter Pipeline to suspend its dividend reinvestment plan earlier than expected, reduce debt, and finance our current capital expenditure program. Finally, I would be remiss if I didn't highlight Inter Pipeline's recently published 2019 sustainability report. We have made significant progress increasing transparency and reporting on key initiatives associated with the environmental, social, and governance topics, and are keen to share our performance with all stakeholders of Inter Pipeline. We are particularly proud of our strong emphasis on employee mental health and commitment to sustainable practices and operational excellence. For example, we recently announced a 10-year, $10 million partnership with the Northern Alberta Institute of Technology called Plastics Research in Action, which will identify projects that advance the reuse and recycling of plastics in Canada. We will continue to expand our ESG efforts to ensure our business operates in a long-term sustainable manner. Now, I'll turn things over to Brent to provide additional details on our financial results.
Well, thank you, Chris, and good morning, everyone. Inter Pipeline generated FFO of $873 million during 2019, which is down from an annual record of $1.1 billion in 2018. Net income for the year was $539 million, also representing a decrease from the record $593 million earned in 2018. During the fourth quarter of 2019, Inter Pipeline's FFO was $217 million, with strong results in the oil sands transportation, conventional pipelines, and bulk liquid storage segments. Results within the NGL processing segment were impacted by weak commodity pricing, maintenance, and turnaround activity. Our oil sands transportation franchise continues to be the foundation of our business, generating $154 million in FFO, consistent with the comparable period in 2018. Throughput volumes reached a new quarterly record on each of our three pipeline systems and totaled over 1.3 million barrels per day. In general, financial results in our NGL processing segment were impacted by lower frac spreads, with declines in NGL product pricing and an increase in AECO natural gas. Moving on to our straddle plants, Empress 2 and 5 performed in line with previous quarters, but Cochrane volumes were impacted by a planned partial outage in October. At Redwater, inlet and production volumes were impacted by an extension of turnaround activities of Pioneer 1 and Pioneer 2 into the fourth quarter, as well as maintenance events at third-party upgraders. Our conventional oil pipelines business generated quarterly FFO of $45 million versus $25 million in the comparable quarter in 2018. Conventional results were positively impacted by higher volumes transported, lower operating expenses, and an improvement in midstream marketing contribution. Midstream marketing activities generated $8 million in adjusted EBITDA during Q4 2019, compared to a loss in Q4 2018. Our midstream marketing operations continue to benefit from attractive term butane pricing, as well as favorable crude oil differentials. For the full year 2019, midstream marketing generated $33 million of adjusted EBITDA after corporate cost allocations. During 2020, we expect to generate between $30 million and $50 million in adjusted EBITDA, which is subject to pricing differentials, volumes, and corporate cost allocations. Our bulk liquid storage business generated strong results during the quarter, with FFO of $31 million, double the comparable period in 2018. The $16 million increase reflects the additional cash flow from the New Star acquisition, as well as higher storage demand, particularly in Denmark, primarily as a result of IMO 2020. Consolidated utilization rates have demonstrated a marked improvement since the beginning of the year and averaged 93% in the fourth quarter of 2019, up from 68% in Q4 2018. Corporate lead G&A and financing costs increased during the quarter and year ended December 31st, 2019, when compared to the same periods in 2018. The increase in G&A was driven by a multitude of factors, including higher employee and HPC readiness expenses, higher professional fees, as well as costs associated with the addition of 7 new terminals in Europe. Higher financing costs were incurred as a result of interest associated with the issuance of the subordinated hybrid notes. Finally, we remain committed to operating in a financially prudent and flexible manner. In November, we successfully issued $700 million of hybrid debt securities, bringing our total to $1.45 billion issued during 2019, with proceeds directed towards repaying amounts drawn under existing revolving credit facility. As at December 31st, 2019, our $1.5 billion revolving credit facility was essentially undrawn, and we exited the year with a consolidated net debt to total capitalization ratio of 41.3%, which is well below our bank covenant level of 65%. So this concludes the formal portion of the conference call, and I would now like to turn the meeting back to Jesse to open the floor for questions. Thank you.
Thank you. At this time, I would like to remind everyone, in order to ask a question, please press star then 1 on your telephone keypad. We will pause for just a moment to compile the Q&A roster. Your first question comes from Jeremy Tonet with J.P. Morgan. Your line is open.
Good morning. I wanted to start off with the storage asset sale process and recognize that you might not be in a position to say much at this point, but just wondering if there was any color you could share now as far as the level of interest that you have been receiving in that process, any color there, and if a sale were to not come to fruition for any reason, how would that impact, I guess, your funding plans as far as DRIP versus equity, or how you think about funding HPC in that scenario? Thank you.
Thanks for the question, Jeremy. It's Chris speaking. I'll address the first part of the question. I'd say on the level of interest, the very fact that the process remains very active, I think, is a great signal at the level of interest we've had in the sales process. And I could just reconfirm my statement that we do expect that we'll be in a position to conclude this sale process one way or the other in the coming months. So it will come to an end here in the short term. And on the funding side, I'll turn that over to Brent.
Yeah, hi Jeremy, it's Brent. So let me set things in context a bit here. I think it's important to remember that the objective of the full, or let's say if it does turn out to be a partial sale of bulk liquid storage, really is to fund our equity needs for the HPC project. Now, once the sale is concluded, or if not, we will update the market on our plans and the implication on the PDRIP. So, it's too early for me to be saying and speculating, what this will all look like, and we're certainly focused on the sale of bulk liquid storage, and certainly, as Chris mentioned, we hope to bring that to a conclusion by the end of Q2, and then, we will update the market to our funding plans then and the implication on the PDRIP.
That's helpful, thanks. And maybe just turning to HPC for a second here, and we've seen commodity prices decline a bit here, and polypropylene prices as well come down. And just wondering, is this having any impact on your conversations with potential customers and trying to hit the kind of the targeted contracted levels that you were seeking here?
The nice thing about HPC is that there's two fundamental principles on why people contract with it. It's because they're taking a long-term view on not what is the ultimate price for polypropylene, it's the spread between polypropylene and Alberta propane. So it's the spread that matters, not the discrete price for one of those products. And short-term fluctuations in the spread, my belief, are relatively irrelevant. And if you take a look in our investor deck, we actually updated one of our key slides on that topic, which shows from both the polypropylene producer side and the Alberta propane producer side, the indicative uplift that somebody would have gotten in any given year if this plant was in operation. And even with softer polypropylene prices in 2019, our math shows that Alberta propane producer, for example, would have got a 75% higher net back for their propane through our plant. And I think that's a great number.
That's helpful, thanks. And maybe just one last one, if I could. As far as the NGL processing facilities, just wondering how you see them running this year. Are there any kind of expected turnarounds that we should be factoring into our model at this point?
Hey, Jeremy, it's Jim Madro here. And to answer your question quite briefly, no, we don't have anything planned for the first half of 2020.
Great, I'll stop there. Thanks for taking my questions.
Your next question comes from Linda Ezergailis with TD Securities. Your line is open.
Thank you. I'm wondering if you could give us a sense of what sort of impact some of the changes in rail transport in Canada are having on your business as it relates to decreased speeds, maybe some disruptions in service. Would we see it as a headwind in your Q1 results, or can you be a bit more specific as to the nature and degree of the impact some of these rail changes might have on your business?
Hi, Linda. It's Jim Madro here again. And to answer your question, to date, we've actually seen no impact to our operations at Redwater. However, I think as everybody knows, it's a pretty dynamic situation between the blockades, the speed restrictions, the derailments, and everything that's going on. We're actually getting multiple updates a day from the railroads on how things are changing. So, I don't really know how that may impact things into the future, but to date, we're not seeing any impact. That said, we do have an excellent transportation logistics team that are all over the situation and have been very successful in keeping our products moving through the most recent situation, as well as the strike that occurred late last year. We've experienced minimal impact to our operations at that time as well.
Okay, that's helpful context. And in terms of volumes that you're seeing beyond just planned outages not happening the first half of this year, I'm assuming Cochrane volumes are strong and utilization has generally been strong across your NGL business so far year to date, and would that be your
Yeah, that's right. Cochrane is running well, as is our Redwater fractionator and the Pioneer plants.
Yeah, I think Jim's understating it. Cochrane's actually running great. Like we're processing very high levels of liquids right now, which certainly helps in a depressed commodity environment.
Okay, that's helpful. Can you maybe give us a bit more sense of the actual EBITDA impact on the Pioneer 1 and 2 and Cochrane outages in Q4 so we can just kind of help refine our forecast going forward?
Linda, it's Jeremy. Maybe I'll just call you offline on that one, and we'll get back to you with some numbers. If we'll have to track some of that down. I'm not sure we have that right here handy to discuss.
Okay, thank you. I'd appreciate that. I'll jump back in the queue.
Your next question comes from Rob Hope with Scotiabank. Your line is open.
Morning, everyone. First question's on HPC. So at the end of the year, it was 65% de-risked. Wondering if you have a breakdown between the PDH and the PP there. And then secondly, as you move through 2020, how do you think that number increases? And are there any large packages that we could kind of see bid out in the near term?
That's a good question, Rob. I don't have the breakdown in front of me on the split between PDH and PP when it ties to that 65%, except a general comment that the majority of that would certainly be the PDH plant, given its advanced state of completion. Regarding milestones for 2020, there definitely are a few. We're speaking to capital, clearly that we're believe that we're going to be mechanically complete in and around the end of this year. We're pretty comfortable we have a good line of sight on the final capital for that plant. The polypropylene plant, where it was always been part of our plan in the first quarter to or 4 or 5 months, I guess, of 2020, to do a full bottom-up refresh of the polypropylene capital estimate. And that's because we're now heading into heavy construction of that facility. We're now starting to get actual construction packages let out into the market versus just our internal estimates. So we're doing that bottom-up refresh right now, and we expect that to be complete, and we'll be able to speak to it in time for our Q1 results in May. And at the same time, we've also had a highly successful hiring season over the past, I guess it's really been a matter of many months here now, and we've got the majority of our operations staff on board, including the entire operations leadership team, and they're now doing a complete scrub of our commissioning and readiness plans for the facility, and that's a huge effort for a complex facility like that, and it's not to be understated in terms of both capital investment as well as just level of activity for commissioning these plants. And we also expect that refresh to be done in time for the May Q1 results. So I'd look for that in May when we come back to the market on what we're seeing for final costs.
And then as a follow-up, is the work you've seen so far in the refresh, according to plan?
I really want people to do the work before I kind of opine on what my gut's telling me, but maybe I'll just do it anyway. It wouldn't surprise me if there weren't modest increases, particularly when it comes to the commissioning and readiness plans, now that we have the team on board that's actually going to be leading that effort. So there could be a modest increase there. Do I expect the number to materially impact the overall economics for the project? No, we don't see anything that would lead us to that conclusion.
All right, thanks for that. And then just in terms of the funding, and I realize that the storage sales a question mark, but if we look just higher level, what equity needs do you think are required to finalize or finish up HPC?
Well, it's Brent again. I'll go back to my previous comments, Rob, and that, I'm not just going to give you a number, but again, I'll reiterate that, certainly one of the main objectives with the bulk liquid storage sale is to really take care of those equity needs for HPC. So that was really the plan here. And, so that depends on, if we're going to have a successful sale or not. And if we don't, we'll update the market as to what our plans are going to be at that time. And even the same thing, if we do have a full or partial sale, we'll see what those proceeds are. And but certainly our objective is to be able to turn off the P-drip through a sale of bulk liquid storage.
All right. Thank you.
Your next question comes from Robert Catellier with CIBC Capital Markets. Your line is open.
I just have a couple of quick follow-ups here. First of all, just want to dig into the rail situation. I think you addressed the current operational impacts, which seem to be minimal, but I trust it's the same situation in terms of getting equipment in for the PDH polypropylene construction. No major impacts there?
Yeah, we're in a good situation there where we do have the vast majority of our major equipment is already on site. There's obviously going to be bulk materials and things like that that will be required to be delivered, some by rail, a lot by truck. But right now, we're not predicting any hiccups related to rail.
Okay, and then in addressing the PDH costs, it seems like most of your attention or your comments were focused on the commissioning readiness plan, but are you seeing anything in terms of just generalized CapEx inflation in the Alberta economy that would impact the PDH?
No, we're quite pleased with how the construction activities have progressed and continue to progress in that regard.
Okay, thank you. Just a final wrap-up question here. You've effectively paid minimal cash taxes the last 2 years, and kind of looks to be, how it calcs out for us in 2020 as well. So maybe, Brent, do you have a comment on the cash tax outlook for 2020?
Yeah, certainly, Rob. So, really what we're expecting is cash taxes are going to be really quite minimal in 2020. And I can actually give you an estimate of a number, and it's pretty small. So on the Canadian side, we think it's going to be around just $1 million. And then over in Europe, and again, that would be if we retained the whole operation for the year, it would be around $4 million. So it's relatively minimal.
Okay, fantastic. Thanks.
Your next question comes from Ben Pham with BMO. Your line is open.
Okay, thanks. Wanted to go back to some of the funding questions that were asked, and as you mentioned, bulk liquid sale largely meets the equity needs. But I guess when you turn off the drip, you lose a bit of EBITDA from storage. I guess there's a leverage balance sheet impact from that. So my question really is there room for you guys, I think, on your balance sheet to take on more debt right now as you get into this really odd phase of huge free cash flow generation in a few years, but you kind of have to manage it over time?
Yeah, it's Brent here again. I'll take that one. When you say is there room for more debt, yes, but there's always a practical limitation on that, and that would speak to the credit ratings and our commitment to that. And so, what I can say to that, we are committed to investment-grade credit ratings, and we're continuing to work very, very closely with the credit rating agencies and understanding how they view us. So, it really goes without saying that we do expect that leverage is going to remain elevated throughout the HPC construction period. And, obviously, when HPC comes on, we've got a line of sight that those metrics are going to be improving by quite a bit when it comes in. So, we're in a constant dialogue with the rating agencies, understanding their perspective on it. And, I can certainly tell you that, to be a little bit more specific, we're committed to a BBB credit rating. And, we're keeping a close eye on that.
Okay. we're really, each year passes by, you're getting close to that EBITDA, 450, 500 million. Have you? I'm sure you've thought about it, but are you at a point where you can talk about just cap allocation priorities in 2022?
Probably not today. I think first off, we'd like to see some recognition of the 450 to 500 million EBITDA in our share price. That would be first and foremost, and then we'll make determinations on how to use the cash flow. I think overall, I wouldn't expect how we run our business to materially change versus how we've done it in the past. For example, we're very fond of steady ratable dividend increases, and we think HPC could support that over the long term. We're also very supportive of maintaining good, strong credit metrics. And what's left after that would be funded back into the business in the form of capital for organic growth projects that materialize over the coming years.
Okay. And maybe lastly, can you remind us your oil sands position? You had a couple $2 billion of projects that could move forward. I mean, we see it 2 years from now. You got PDH and generate a lot of cash flow, and you got L3R, Trans Mountain, Keystone also in the mix. I mean, aren't you well positioned to expand your oil sands pipes as well?
Absolutely. We do believe that all we need to go back to a growth phase in our oil sands transportation business is export pipeline capacity. And we think that will definitely spur somewhat of a renaissance in development from particularly the established producers in the oil sands arena. And we think we have a extremely strong strategic position to capture, I'll call it our fair share of growth opportunities over the coming years.
All right. Thanks very much.
Your next question comes from Robert Kwan with RBC Capital Markets. Your line is open.
Great. Good morning. If I can start with Heartland. You had a statement in the MD&A that you continue to progress your phased contracting strategy, and I guess that's a new statement. So I'm just wondering, were there contracts that were executed in the fourth quarter?
I don't want to get into specifics of when contracts were signed, but yes, we continue to sign new contracts. So we're definitely making progress in that area. And I'm not sure that's a new statement. At least it's certainly not been a new statement in terms of our public discussions on conference calls and in our IR deck. We do definitely continue to make progress in that area, and that was not intended to be some sort of new statement in the MD&A.
Okay, so there was no kind of material new contracts that kind of was a major step change in the fourth quarter that you wanted to message?
No, we weren't trying to subtly message anything in particular, other than we're making progress. Take the words at face value.
Okay. Just on the costs and ahead of what sounds like an update in the first quarter, I'm just wondering, when you think about messaging a change in costs, or as you're just thinking about keeping the within budget statement, how much either under or over budget, maybe percentage-wise, would you need to be before you felt you needed to message where you are to the public?
Yeah, I think it's a question about materiality to the overall project. I'm not going to quote a specific range, but when we FID'd this project, over 2 years ago, we had a view on the capital. There was a tolerance around that original estimate that we thought was reasonable given where we're at particularly on the engineering side of the project. And we were comfortable FIDing on that basis. We certainly didn't believe that it was with $10 million over $3.5 billion that was a bust in the number. So when you give the track record on large mega projects, around North America, we're quite comfortable that our project is tracking nicely around our original budgetary targets. But we do think it's important, no matter what the number is, come May, it was always our plan to put a new number, because this will be our final estimate for the overall project before it's complete. And look for that number shortly.
Okay, and when you say it's your final estimate, is there going to be a change in locking down the remaining costs to something more of a fixed price EPC and minimizing unit rate?
No, our construction plan isn't going to change. It's merely it will be our highest class of estimate that you can actually accomplish in a project of this stage, when you're at this stage of construction. And we'll just discuss any variances to that final estimate when the project is done. In terms of locking down costs, for example, it's a bit of a misnomer. Lump sum contracts are great contracts if you've completed a sufficient amount of engineering to actually lock down, we call it the scope with a construction firm. But in many ways, lump sum contracts merely give you a floor price on what you're going to pay for a work package, and any changes to that are extras. So there's no easy way to de-risk major projects like this if you haven't done all your detailed design ahead of time. That's a risk that any owner always takes.
Got it. And maybe if I can just finish with a capital allocation question. As you think about what's in front of you right now, is the focus pretty much entirely on just putting your head down and executing Heartland as well as maybe smaller organic initiatives within your existing assets? Or is M&A or acquisitions a potential in the relatively near term?
Yeah, M&A is not a big focus, Robert. You've known us a long time, and we've always just been opportunistic acquirers in any event. So to the extent a package comes to the market, we would always look at it. But I wouldn't say it'd be a particularly high priority unless it was a no-brainer for Inter Pipeline.
Okay, that's great. Thank you.
Your next question comes from Dennis Fong with Canaccord Genuity. Your line is open.
Hi, good morning, guys, and thanks for taking my question. I've got two, and they're somewhat follow-up. Just maybe within the context of your logistics team and how you guys are dealing with some of the rail interruptions and so forth. You mentioned mostly on the volumetric side. Or should we bear in mind some kind of incremental cost or a longer path required to move some of your volumes to the directed market? And how should we be thinking about your utilization of storage, especially as we're coming out of the winter consumption season for propane, and your ability to utilize that to buffer some of the near-term impacts? And I have a second follow-up. Thanks.
Hey, Dennis. Yeah, it's Jim Madro here again. I don't think we're seeing any, our destinations aren't really changing, and we're not seeing any material changes to our rail rates from what we're seeing at this point in time. One of the things that I didn't mention is that, and as you pointed out, was we do have storage capacity for certain products, including butane and propane. So if we do get into issues, we can always go into storage with those products. Some of our olefinic products, we do have to move them on rail, so it's a little more challenging from that perspective. But again, to date, we haven't seen any issues, and the team is on top of making sure that things are moving.
Okay, perfect. And then just the second question here is just around the interterminals business. Obviously, with the context that later this year you're going to be providing a bit more of a fulsome update, and understanding that I don't want to say we're necessarily getting long in the tooth with respect to the entire process, but what are some of the, we'll call it, alternative forms of value crystallization that you guys are currently exploring from the context of the strategic alternative, if it doesn't culminate in a full or partial sale?
Yeah, I guess speaking to the length of the process, I think as I've mentioned previously, this is, to our knowledge, the largest storage sale that's happened in Europe in any sort of medium-term memory. It's also multi-jurisdictional, 6 countries, 23 terminals, almost 40 million barrels of storage. It's a huge package, and it does take time. So I think it's frankly taking exactly the amount of time it needs for us to work towards extracting the maximum value. And we are committed to wrapping this thing up one way or the other in the first half of this year. When it comes to other, call it potential levers that we can pull, there certainly are other levers. I definitely wouldn't be comfortable talking about it on the call today. Let's get through this process, and we'll speak to it once we've crystallized on a decision, and then we'll update the market on our financing plans going forward.
Again, if you'd like to ask a question, please press star one. Your next question comes from Patrick Kenny with National Bank Financial. Your line is open.
Yeah, hey guys. Maybe for Brent here, just if you do end up keeping the bulk liquid storage business, is there any more balance sheet capacity for additional hybrids going forward, or are you pretty much tapped out at the 1.4, $1.5 billion level? And then also maybe just an update on what the plan would be to refi both the $500 million term loan this August as well as the $500 million of MTNs in July.
Sure. So the first part on the hybrids, Pat, we've basically used up our capacity at the current time. So we've, as you pointed out, we've issued 1.45. We kind of calculated our cap at the current time at about 1.5 billion. When it comes to the refinancings, I can't give you any specifics, but I can tell you what I can tell you. Say what are the dynamics here, and obviously the very first one is if we do have a sale of bulk liquid storage, that would determine, it would obviously have a big impact on what our plans would be in terms of refinancing those MTNs. The other part that you do have to remember here too is we do have a substantial amount of undrawn capacity in our revolver. As we noted at the end of this year, it's basically undrawn. So that would be the other option too. And this is, it all, I think, sort of goes to point out that we've got some flexibility around the refinancing of these MTNs.
Okay, great. And then maybe for Chris, you guys recently published another solid sustainability report. How do you think about framing your ESG story going forward, or taking your disclosure to that next level, either through establishing GHG reduction